all intents and purposes, that the company's good, it doesn't close down. They have the ability to be able to pay it, because at the end of the day, if the company doesn't have the ability to pay it, then after the 7 year duration, there's a chance that you don't get your money. The reason why it's not risky, or at least the risk is lower, is that if you place ₱1 million, the company is good. At the end of year 7, you get your 1 million peso back. There's no loss on capital from your end, and then you get rewarded by getting interest rate payments. So think about that concept, but look at it from a perspective of stocks. In this video, I want to talk about how you can get passive income in the stock market without experiencing a lot of volatility. So for those who have been following me for quite some time, I know we've been talking about dividends, but a lot of the dividends that I've been expressly talking about also were mostly common shares, and also were REITs. REITs essentially are still stocks. But if you look at how common shares would go and also REITs would go, they are still subjected to a lot of volatility. It's not that other stocks are immune to volatility or not as affected, but the only way somehow you buy a stock, and then the only way it gets redeemed, is either you sell it at a profit or a loss, or if the company starts to delist. The same way also with REITs. And the narrative there is that would be pretty much dependent on what price you've bought it. So it still would subject you to a chance of getting a loss, even if you hold on to it for the long term. So there are a lot of fundamentally sound companies that when you start investing in them, hold it for the long term, then you get paid dividends. And because they're good over a stretched period of time, there's a larger chance also that the price that when you sell it would be relatively higher. Not a lot of people can take volatility. Not a lot of people that, even if they know if the company's good, not a lot of them can take drops. And that's something that's very understandable. And this has something to do also with my age right now, that I'm nearing 40 years old. I've been taking a stance also to get more, somehow shift and pivot into assets that are leaning towards giving me cash flow on a regular basis. Common stocks that give dividends are one of them. REITs are also one of them. But another one are preferred shares. They're essentially still stocks. So there's two types of stock. You have a common stock, and then you also have a preferred stock. When you own a preferred stock, it's similar to a bond. For those who are asking what a bond is, basically a bond is a security that's issued, but it's a debt. Meaning, if Ayala Corp borrows money, they would pay that investor a specific amount of interest over a period of time. So say it's a 7-year bond. After 7 years, the money of the investor is returned, and throughout that 7-year period also, the investor gets interest payments as a form of payment for the money that they invested. And in turn, Ayala Corp could use the money for other projects that they're trying to do, or whatever plans that they have to fulfill. And bonds become relatively low risk as compared to other assets, because if all intents and purposes that the company's good, it doesn't close down, they have the ability to be able to pay it. Because at the end of the day, if the company doesn't have the ability to pay it, then after the 7-year duration, there's a chance that you don't get your money. The reason why it's not risky, or at least the risk is lower, is that if you place ₱1 million, the company is good. At the end of year 7, you get your 1 million peso back. There's no loss on capital from your end, and then you get rewarded by getting interest rate payments. So think about that concept, but look at it from a perspective of stocks. The difference though, when you say stocks versus a bond, is you become a part owner. If you are looking at bonds, you're essentially just a lender. When you buy a preferred share of Ayala Corp, you become a shareholder of Ayala Corp. Bondholders are given higher preference because that's debt. So meaning in terms of who gets paid first, bondholders get paid first than stockholders. But right after that, you get your preferred share owners, who will get a piece of the pie. Now, essentially, what's preferred shares? So here's the main difference also of preferred shares and bonds. If you're looking at bonds, it's debt. If you look at preferred shares, it's a portion of the profits that's redistributed in form of dividends. But the reason why somehow it's in parallel compared to bonds is essentially if you place ₱1 million, provided that it's also a 7-year preferred share, at the end of the 7th year, your 1 million pesos gets returned to you. And whatever the rate of return, you get rewarded by that for the 7 years that you are holding that preferred share. But here's what makes it very interesting. Number one, you can buy them a little by little, and you can also sell them little by little. And like bonds, there's a lot of paperwork involved. You also have to like have a branch manager of a bank to help you out. There's a lot of paperwork that you need to do. And normally the most ideal for you to be able to do it is buying it from its primary offering. If you buy it from its secondary offering, meaning it's already out there, you're just buying it from someone else, you will incur more charges. And not just that, you can't buy it little by little, you can't stack little by little. So if you're the type of person that makes money from a salary, and then you said that I'm just gonna stack preferred shares on a regular basis, you can't do that. For bonds, you can't actually do that because you need large amounts of money to be able to buy the bonds. And second thing that makes preferred shares interesting is that the taxes are only 10%. When you go the bond route, you get taxed 20% withholding tax. So for example, you place a million, it earns 7%, you get taxed 20% of that. So 7% of a million is about 70,000 pesos. And then if you less 20% of that, that's 14,000. So you're left with 56,000 pesos. Whereas for preferred shares, the tax is only 10%. So say you earn also the same 7%, you only will pay taxes in form of 7,000 pesos, which is 10% of the 70,000 that you actually earns, and your take home will be much, much bigger. But here's what you need to understand also. In terms of risk versus reward, bonds are generally safer. Preferred shares are generally riskier. So essentially, all things are equal, preferred shares should give you a higher rate of return because it's giving you a larger amount of risk as well. So that's what I want to submit to all of you, that there's a way for you to be able to earn passive income without experiencing the volatility, or at least having the day-to-day volatility of the market, and with an expectation that if you place a million pesos, you will get the same million pesos back when it matures or when it gets called back. But not just that, you also get a rate of return, only withholds 10% tax from you, and generally should be higher than what you would get from bonds as well. And it's something that's liquid. So one of the latest ones, and of course, generally everyone knows that Ayala Corporation is one of the biggest companies in the Philippines, but do your own due diligence also and do your own research. Please spend the time to be able to analyze it as well. That don't just buy it just because I mentioned it here. It's your money, it's your responsibility, and it has to be you who should take the time to learn and understand what it is, that it has to be you who needs to somehow take part and know what you're getting into. Ayala Corporation, their issuance of a preferred share, it's called AC PAR, ACPAR. Its dividend yield is about 6.3 plus percent, would entail that you would get somewhere around 5.5 to 5.6%, less than 10% taxes that is there. The stock price of its listing was around 2,500. By the time I'm recording this, the stock price is generally higher than that. It's about 2,510, 10 pesos higher than its issuance price. But if you try to analyze it, the dividend yield is almost the same still. It's not as liquid though. If you're putting in large amounts of money, it would be very, very hard for you to be able to buy it in one go. When you talk about preferred shares, they're boring. They don't move as much. What it does is it gives you stability. It gives you predictability, that if you place a million pesos, 7%, you know that million pesos will get you 6.3%, and you will get around 63,000 pesos, less than 10% tax attached to it as well. It gives you liquidity, it gives you lesser volatility, and it gives you also an amount that you can expect to come your way on a regular basis. If you're the type of person that wants to learn more about that, I do believe that this is something that's worth looking into, especially if you're nearing my age also, that you're getting older. Maybe title this video Passive Income for 40-year-old people, that how can you get passive income via preferred shares if you're getting older, if you're valuing getting cash flow on a regular basis. And via preferred shares is one of the best ways, or at least a route that you could actually explore if you want to do it as well. So assignment, research more preferred shares. Number 2, research more on AC PAR. Check if the dividend yield is acceptable for you, and check also that, hey, okay, if I do AC PAR, comparing it to other assets also out there, is it something that fits me, or is it something that's not as suitable for me as possible? Because at the end of the day, it's not a one-size-fits-all strategy. What matters is if you do your own due diligence, try it with a small amount and see if it's something that works for you. If it is, scale up, put more. If it's not, then okay, maybe you could come up or invest with something else that fits you more. So if you want to know more about that, check out the links down below. If you want to check out brokers that you can buy stocks in the Philippine markets, check out the links down below as well. And if you want to learn more on how can you invest, I've written books about it. I've also have webinars that you can watch on demand about it as well. So that's it for now. This is Marvin Germo I hope this video helps you trade well, trade strong, trade smart. See you all again soon, and God bless you all.